Welcome to the Quiet Exit podcast, where UK business owners find clarity, confidence, and calm as they think about stepping back. No noise, no pressure, just the next chapter done right.
Hello and welcome back to the Quiet Exit podcast. I'm McConachie, and this is a camp space where UK business owners can think about their next chapter without noise and without pressure. Today we're doing something useful and practical. Rather than one mindset idea, we'll walk step by step through the business acquisition process from your side of the table. Then move into what actually lowers buyer risk and how to keep the handover humane. For most sellers, this is unfamiliar territory. Even if you have sold before, it may have been under pressure or through a public process. The quiet exit way is different. It is slower, more human, and focused on clarity before commitment. By the end of this episode, you will know what happens from the first conversation to handing over the keys, where the real decisions live, and how to make the transition steady for your team. We'll cover when to begin talks, what a good discovery conversation sounds like, how offers are shaped and negotiated, what due diligence really involves, and how to plan a handover that protects people as well as terms. If you'd like a visual, there's a downloadable acquisition journey map inside the Quiet Exit Club. You can get it anytime at epitomycapital.co.uk/quiet-exit-club. Let us start at the beginning. Step 1. Awareness and readiness. This is before you speak to any buyer. It is the whisper that says maybe it's time to see what is possible. It's not about selling tomorrow. It's about creating the conditions where you can explore without panic. Check 3 things. Emotional readiness. Can you imagine life outside the role? Operational readiness. Can the business function without you in every meeting? Financial clarity. Do you know what you need, not only what you want? Skipping this stage shows later. Rushing into talks can end with cold feet when reality lands. We slow down here because strong deals start with steady sellers. Step 2. Initial connection. Either you reach out or a buyer reaches out to you. The tone of this first exchange sets the pace for everything that follows. If you feel a hard sell, a rushed NDA, or vague promises, it's a sign to step back. If you meet curiosity, patience, and clarity, you might have the right buyer in front of you. When we first speak with an owner, it's a conversation, not a pitch. We want to hear how you built the business, what matters to you, and how you want the future to look. We also explain openly who we are and how we work, so you know this is a direct discussion, not a listing process. Trust begins here, or it doesn't. Step 3. Discovery conversation. Usually a 1-hour call, sometimes face-to-face. This is not due diligence, and it's not a valuation meeting. It's an exploration. We cover the history, the key people, the shape of the customer base, current challenges, and your hopes for the future. Notice that sale price is not on that list yet. That comes later, once the whole picture is understood. This is also where you ask us anything about our process or what happens next. A good buyer will welcome questions. Step 4. Early alignment check. Before numbers, we check values. Do our timelines match your comfort level? Do you trust us to keep your people your brand and your customers at the heart of the deal. If we can't align here, there's no point talking offers. It's fine to walk away before you start. The wrong buyer, even at a higher price, costs more than the right one at a fair price. Once alignment is there, we move to shaping the offer. Step 5. Offer shaping. A buyer takes what they've learned and begins crafting something that works for both sides. The first offer is not a verdict, it's a starting point. A good buyer explains the why behind each figure, not only the headline number, but the structure. There are 3 components to understand. Headline price, payment structure, meaning what is it up front and what is deferred or contingent. Conditions, such as key contracts remaining in place. Many sellers focus on the headline price. Often, structure matters more to peace of mind. An all-up-front deal at a slightly lower price can be safer than a higher price spread over years with risks attached. We explain how we arrived at our numbers, the assumptions, and where there's flexibility. An offer is not just a number, it's a trust document. Step 6. Negotiation. This word can make people tense. In the quiet exit way, negotiation shapes a deal everyone can live with after the papers are signed. Think beyond money. Ask yourself, will I be proud of this handover? Will my team feel secure? Will customers still receive the service they trust? Deals often fail not because of price, but because of unspoken expectations. Bring them into the open early. Sometimes this takes weeks, sometimes days. The goal is clarity, not speed. Step 7. Heads of terms. Once you agree the key points, they go into a short non-binding document. Think of it as the blueprint. It outlines price, payment terms, timelines, and any special conditions. It is not the final contract. Why it matters? It stops drift later. Both sides have a clear reference before lawyers draft the details agreements. At this stage we ask, does the document reflect the spirit of what we discussed, not only the letter? If the spirit is missing, the letter will not hold. Step 8. Due diligence. This stage worries many owners, but it doesn't need to. It's simply verification that information shared matches reality. Financial diligence looks at accounts, tax filings, and major contracts. Operational diligence reviews processes, roles, and suppliers. Legal diligence checks disputes, compliance, and regulatory matters. Being organised makes this smooth and far less stressful. We often help prepare a simple diligence pack so nothing is a surprise. A good buyer is not looking for perfection, they're looking for honesty. Issues rarely kill deals, surprises do. When diligence is complete and both sides are satisfied, we move on. Step 9. Legal agreements. Lawyers turn what is in the heads of terms into binding contracts. Make sure your legal team understands your priorities, not only liabilities. You're protecting the outcome as well as the risk. Next comes step 10, completion and handover. At That's where signatures go down and the real transition begins. Step 10. Completion and handover. Many picture this day first, but completion is not an ending. It is a bridge. In a quiet exit, the day is calm, no fanfare unless you want it. The focus is alignment on immediate next steps. We confirm funds, make any agreed announcements, often internal first, and then move into the handover. Handover looks different for each seller. Some step away within weeks, others stay involved for months or years in a lighter role. Define the handover goals, client introductions, supplier relationships, and mentoring for new leadership. Without a clear plan, transitions can feel messy. I've seen informal promises turn into unpaid full-time work. We document scope, timeline, and boundaries in the heads of terms to protect both parties. Step 11. Post-completion support. Not every deal needs it, but many quiet exits benefit from light support. This can be short advisory calls, historic contacts, or an occasional strategy meeting. The role should feel light, not lingering. The aim is value without dragging you back into the day-to-day. Step 12. Integration. The business begins operating fully under new ownership, either immediately or gradually as systems and culture blend. This is where many sellers breathe out. The work continues, customers are served, staff are engaged. You realise the business can work without you. That moment is powerful. A good sale is not about leaving cold. It's about seeing what you built thrive without you holding it up. Step 13. Life after the sale. This part is rarely planned, yet it shapes how you feel about the whole journey. I've seen how owners go from 60-hour weeks to open diaries and feel the void. With a little intention, others slide naturally into travel, mentoring, volunteering, or a new venture. Think about what matters before completion. The landing will be smoother. We don't treat completion day as the end. It is one milestone on a longer path. So that's the full arc from first contact to life beyond the sale. Now let's step deeper into the seller's experience so you can navigate with more clarity and calm. Knowing the steps is one thing, feeling ready is another. Preparation is your quiet superpower, because the process is only half the work. The other half is managing the emotional load. Selling is not just a transaction, it's a transition. Your thoughts, feelings and identity will shift. If you do not expect that change, it can feel like the ground is moving. Common emotions include excitement, relief, anxiety, doubt, pride, and sometimes grief. Expect these feelings. When you see them as normal, you avoid reactive decisions. Let's map the common pitfalls and what to do instead. Pitfall 1. Waiting too long to prepare. Pressure rarely leads to the best deal or smoothest handover. The best exits start from strength, when you still have energy and choice. Pitfall 2. Overvaluing based on emotion rather than market reality. Your story matters, but buyers price future earnings and risk. Match the story with defendable numbers. Pitfall 3. Holding back key information. Hiding issues damages trust later, A good buyer expects challenges. Share them early with a plan. Pitfall 4. Trying to manage the sale entirely alone. Even in a direct deal, legal, financial and operational threads need specialist eyes. Make sure advisors are aligned with your goals. Pitfall 5. Neglecting your own well-being. Fatigue affects judgment. Keep the routines that keep you steady. Now the positive patterns we see in sellers who feel good afterward. Pattern 1. They start conversations early, out of curiosity rather than urgency. Pattern 2. They're open about challenges and willing to collaborate on solutions. Pattern 3. Think about life after the sale long before heads of terms. Pattern 4. They maintain trust from first meeting to final handshake. When trust is high, problems are solvable. Pattern 5. They allow themselves to feel proud. Marking the moment matters. With pitfalls and patterns in mind, let us move to what you can directly control to lower risk and keep negotiations rational. Here are the 5 levers that make the difference. These levers reduce buyer risk and raise confidence without turning your life upside down. Stay with me. This is where it starts to click. Lever 1. Proof of earnings. Buyers believe patterns more than promises. Create 3 proofs. A 24-month monthly P&L that ties to filed accounts. A customer retention snapshot for the last 12 months. And a cash reconciliation that shows how invoices become money in the bank. If anything is messy, do not panic. Flag the gap and your plan. Honesty reduces risk faster than polish. Lever 2. Continuity. If you were gone for a month, what would wobble? Use a 2-layer test. Layer A is role cover for your top 5 tasks. Layer B is where knowledge lives in writing. Turn it into a light playbook. 5 SOPs, key logins, key contracts, and decision thresholds. Not a manual, a map. Lever 3. Concentration. Dependency on a few customers, suppliers, or people is the question every buyer asks. Build a 1-page brief. Top 5 customers as a share of revenue and gross margin, terms, renewal dates, and relationship strength. If one client is over 25%, show mitigations. A second point of contact, a cross-sell pipeline, and a backup plan if they paused. Lever 4. Working capital. Price is not the only cash conversation. Explain your normal cycle, stock held, debtor days and creditor days. Bring a simple glide path for the last 3 months and the next 3, not in seasonal swings. It prevents surprises at completion. Lever 5. Contract clarity. Assignability, change of control and notice periods can make or break timing. Create a 1-page contract schedule. Name, value, term, notice and assignment. If anything needs landlord or client consent, circle it early. How you present these levers matters. Quiet signals build trust. Quiet signal 1. Consistency. Your narrative matches your documents with the same definitions and timeframes. Quiet signal 2. Responsiveness. Clear answers within 2 working days say more about culture than any brochure. Quiet signal 3. Boundaries. Know what to share pre-NDA and post-NDA. Protecting sensitive detail shows you protect clients. 3 microscripts you can use. Setting the tone. Happy to walk you through the story, then the numbers, then the risks we're managing. Does that order work for you? Price versus structure. I'm open on structure if risk is shared fairly. Show me how the moving parts protect both sides. Early disclosure. There is one area I want to raise early, so nothing surprises us later. Here is what it is, and here is how we're addressing it. 2 pitfalls to avoid now. Over-explaining. Answer the question asked, then stop. Offer a document if more details needed. Chasing pace. If a timeline feels too fast, say so. I can move quickly on documents, but staff communications need a cadence. A weekend checklist if you prefer lists. 24-month monthly P&L with brief commentary. Top 5 customers sheet with terms and renewals. Working capital glide path. Contract schedule, 1 page. SOPs for your 5 personal tasks. 1 paragraph vision for the ideal handover. This is not a pitch deck, it's proof, continuity and calm. When buyer blood pressure is low, negotiations stay rational. 1 extra lever is language. Swap claims for evidence. Rather than our service is excellent, say something like rolling 12-month customer churn is 6% and on-time delivery is 98%. Swap certainty for clarity. Rather than no risk, say here is a risk and here is how we contain it. Do this and you stop trying to sell. You let the business speak. Buyers do not need perfection. They need predictability. With these 5 levers in place, most friction points disappear before they arrive. You save time, you keep control of pace, and you protect the people who built the business with you. Let's bring it to life with a real example. Notice how little depended on scripts or spin. It was proof, continuity and calm. Here's the story, start to finish. We'll call the seller Martin, a 58-year-old owner of a specialist logistics firm in the Midlands. He had built the company over 25 years, serving manufacturing clients. He wanted to leave before he was exhausted. He started the conversation early. Exploration was a few informal coffees. We talked legacy, priorities, timeline, and how involved he wanted to be after the sale. He didn't want a sudden handover. He wanted the team supported. That shaped everything. In Discovery, we met the team and looked at resilience. 2 roles were still with Martin. We planned succession before completion. He saw it as strengthening, not a problem. The transition would be smoother. Shaping the deal was straightforward because the groundwork was done. We agreed a valuation range, a sensible structure, and a phased 8-month transition. Heads of terms held no surprises. Diligence found what had already been shared. Meetings were scheduled around peak client periods to avoid disruption. Transition planning was where Martin excelled. We wrote an internal announcement that framed the change as a natural step. New leaders were introduced gradually. Martin ran small legacy lunches to share the company's story and values. Those sessions gave people confidence that the culture would hold. Handover arrived quickly. No drama. Responsibilities shifted over 8 months. By the time Martin stepped back, the team was comfortable. He moved into part-time industry work, sharing expertise without the daily weight. The takeaway is simple. Good sequencing lowers fear for everyone. You don't just hand over a business, you hand over stability. That is the exit people remember for the right reasons. Whether you're 1 year or 5 years away, begin with a conversation about vision, not numbers. When vision is clear, the rest follows. Next time on the Quiet Exit podcast, we'll look at the most common points where acquisitions stall and how to avoid them without feeling pushed. Until then, take care of what you've built and take care of yourself too.
Thanks for joining us on this episode of The Quiet Exit. If you're quietly thinking about your next chapter, you're not alone, and you don't have to figure it out publicly. For more resources, private insights, or to learn how we support legacy-first exits, visit epitomecapital.co.uk/quiet-exit-club. Until next time, stay clear, stay calm, and keep moving quietly.